Trend and momentum are, pretty universal, higher highs, higher lows. Everybody says that, but we do it, with a linear regression moving average. We're not trying to trick anybody. We want you guys to understand what we're doing and why we're doing it and why it works. There's two sets of trigger lines. There's a linear regression and an average of that line, and then there's a linear regression and an average of that line. So basically it's like two moving averages, if you will. And, a moving average crossover is probably one of the oldest technical analysis tricks in the book. Again, we're using theories that have worked forever. And what we're doing, again, I just want to put terminology on this. The smaller, faster averages, we call them the small triggers. The slower, larger moving averages that use more data, we call our large triggers. So I just want to build some terminology for you as you're looking at our charts. And again, we use the trigger lines to determine the trend and momentum in the market. Now, I want you to think about the price bars. Don't think about the triggers yet. I want you to think about the price bars themselves. There's only 3 states that the price bars can be in. As far as location, the price bars can either be above the trigger lines. And when I say the price bars, I'm really talking about the body of the bar. You see the solid square rectangle portion of the bar, candle, if you will. That's the part of the bar that we're watching. And when the price bars are above the triggers, that's one state. And then we're going to have price bars that are actually inside of the triggers, either inside the small triggers or inside the large triggers. And then the third state is price bars below the triggers. And essentially what we're doing is we're using price bars below the triggers to establish momentum to the downside. And then as price bars get inside of all of the trigger lines, like you see down here at the bottom, that's where momentum generally ends, and the market has a tendency to do the same thing in reverse. Price bars above, triggers roll up, and the market may go up. Now, for, age-old wisdom, you've heard this a million times, buy low, sell high, which is a great, great, great idea. Unfortunately, 99% of day traders out there don't have a very consistent, systematic way to define what low is and to know what high is. And what we're going to do today is we're going to give you those things. So before we get into trading, we're going to talk about trading consistently. And you really only need a couple of things to be able to trade really, really consistently. You need strong trigger line momentum up, and then you can buy Fibonacci areas of support. And if the momentum persists, you're going to be able to stay in a trade until you reach a Fibonacci resistance. And you're going to be able to profit by knowing those two levels and understanding the odds of the market continuing in one direction or the other. Now, obviously, the exact same criteria is going to be used when we're looking for short trades, right? When the market's going down, you want to make money, half the time it goes up and half the time it goes down. So you don't want to limit yourself to just buying the market. If the market's going down, we want to sell short at Fibonacci resistance. And if the momentum persists, we want to wait until we get to Fibonacci support to get to a target. So I want to look first, and I want to introduce these concepts, and I want to do it in a real simple format for you. Remember, we said price bars are below the triggers. So you can see that here. It's pretty easy to see. We're going to talk about a momentum phase of the price bars and triggers when the large triggers are crossed down and really wide to the downside. So it doesn't matter what else is going on over here. What we're looking for is the bodies of the bars to be completely below the large triggers. And then we're going to be looking for the width of the large triggers to be increasing and growing as the market's going down. And obviously, that's where we're going to do trades. You remember that tail we were talking about? How the market comes up and then goes back down again? You can start to see how we're going to build a trading plan for you based on this look. And then you'll see, look, price bars get into the weakening phase where they physically get back inside of the large triggers, and then ultimately the bodies of the bars close above the triggers, and we start the process in reverse. And again, I want you to remember this. Momentum phase of the large triggers is when the bodies of the bar are below the large triggers, and they're wide. So not over here, because the trigger lines are crossed up. So what we want for a momentum phase in the large triggers is the large triggers crossed down and the bodies below, large triggers crossed up and very wide to the upside with the bodies of the bars above the large triggers. And then you can see, one more time, just for terminology, a weakening phase where the bodies of the bars are inside of the triggers, which makes the market go the other way. Now, when we look at triggers, we look at both triggers. So, to kind of bring in both the large and the small trigger lines into the equation, you're going to see the same concept. Weakening is when the price bars are inside or starting to get below the large triggers, and that shows your change of trend. Then our momentum phase of the large triggers. I know the small triggers are on here now, but it doesn't change what was happening right here. The large trigger momentum phase with the small triggers below it is a very advantageous look for us, and that's what we're going to use during our trend trade rules. And then obviously weakening, and you're going to have two different phases really. You're going to have a weakening phase, and then initially you're only going to have price bars above the small triggers. And you can have a small trigger momentum phase where the price bars are above the small triggers crossed up well before you get a momentum phase in the large triggers when the large triggers come along. So again, it's going to give you the opportunity. The only time you're going to be thinking about going short is when you're in a momentum phase. The only time you're going to think about going long is when you're in a momentum phase to the upside. And obviously, as the market weakens, you'll start to see the small triggers roll over, which puts us into a momentum phase down on the small triggers, which will usually make the market go down, and eventually we get into a momentum phase on the large triggers. Now, depending on, or no matter, is what I should say, no matter what chart you use, the read of our trigger lines is universal. If you use a daily Tesla chart, it doesn't matter. If you use cryptocurrency daily chart or a 4-hour chart, it doesn't matter. The look is the look is the look. And this is a 13 range S&P chart. And you'll see weakening, price bars below. We're in a small trigger momentum phase, really small and large. And then eventually the bars get inside of the small triggers, which is okay because we have a strong momentum phase of our large triggers, which pushes the market down again. And, just like the dynamic Renko bar, once the price bars and or the small triggers are inside the large triggers, we have this weakening of the trend. And anytime we have the weakening of the trend, that's where we start to lose advantage for taking trend trades. And you can see the process starts in reverse. Price bars above the small, large roll, strong momentum phase up, they start to weaken, everything changes again. Now, I put this slide in here because in our class, people ask this question a lot. And I think it's worth, they're like, well, I can see the odds favorable momentum in the trigger lines over here. It's really easy. The question that a lot of people have is when all the triggers are down, but there's only one of the two small triggers inside, is that a weakening of the momentum? A little bit, but not really. You can still take short trades. You can still take short trades when the price bars are inside and the small triggers are inside as well. That's our weakening look, but where we're going to start to introduce the next concept is when we have Fibonacci support. So weakening is okay until you get to Fibonacci support. Once you have weak triggers at Fibonacci support, that's where the market generally will stop its decline and start to go back the other way. Now, just because the triggers are strong doesn't mean that Fibonacci resistance is going to break. So, again, I wrote in this red line of Fibonacci resistance so you can see it for this little webinar. We want both of the triggers to be well above the red Fibonacci resistance, maybe 2 points on the S&P. It might be, 10 or 12, 14 ticks on crude oil. They just have to both be physically well above Fibonacci resistance before we're going to anticipate resistance to break. Even if the triggers are strong up, if they're located at or below the Fibonacci resistance, the resistance will usually hold. And this is why you can't just say, oh, I'm just going to trade the strong triggers without any idea of where the market may turn. This is where Fibonacci helps you to define that even though the momentum is up, the trend may still be over. And more importantly, once you get into a momentum phase of the small triggers going down after Fibonacci, you'll have your first opportunity to be able to go short and sell the market. And as the move progresses, you'll obviously have all of the triggers rolling and you can continue taking short trades.